Hello investors, how are you? So hopefully you're doing good. Today we will do the Home Depot. The ticker name is HD, and in this talk basically we'll cover this very big agenda, right? So we have a lot to go. We'll cover the executive summary, comparison of the stocks with its benchmark, share repurchases. We'll do the historical trends, liquidity check. Basically this liquidity check will help us how it's doing during the coronavirus time, with whether it's good or not. Go to the use the models like dividend discounts, because this stock is a dividend, so I can use that model and the free cash flow for sure to come up with my value, which is called intrinsic value. So we'll do the stock valuation and see how the coronavirus impacted these quarterly statements. That's also we do. And finally we'll make an opinion. So pretty much we'll cover each and every area, expect and see if this stock is really good from the long term perspective. So that's it's all coming in this video. And if you're new to the channel, don't forget to subscribe. My name is Pramod Kumar. I am a CFA charter holder and FRM certified. And in my channel, basically, I'll go over each ticker and then try to do very deep analysis of that. And just a small request, either you are existing subscribers or new, please give a thumbs up to this video if you like it, and so more and more people will get benefit out of it. And if you can share with your friends, that will be awesome. Okay, let's get started. So the executive summary. Okay, so what is this? So basically Home Depot is the home improvement retailer, right? So this is the perfect brick and mortar stores, and then it has 229 retail stores, 182 in Canada. Actually it's near our neighborhood. And one thing I find, whenever there is a new construction or new area set up, the Home Depot is always there. So from the Canadian perspective is pretty good. 125 is in Mexico, and is a large presence in United States. Of course, based on the country and the population, there is 1984, the total store. And this number comes from their 10K directly, which makes a total of 2,291 total retail stores. So that's pretty much. So usually any home, pretty much I think whoever owned the house and living in this country, for sure they have used this, the Home Depot. Okay, so I think let's go get started now. Okay, so if I compare the Home Depot stocks, which is coming in orange color, with the S&P Retail Composite Index, which is in black color, and the S&P Broad Based Index, which is the overall S&P index from the last 5 years until from February 1st, 2015 to February 2020. And this is the price on the y-axis. So we can see the Home Depot is quite or little shy over its index, right? So it's unable to beat its own index, but it for sure, if you compare with the broad-based S&P 500 index, it's definitely clearly did a very good return. So if you just invested $100 there, the $100 will only be 130 or something less, but you see it's easily over 250. So over 100, almost $100 difference. Actually the dollar terms is clearly mentioned here, so you can also see here, right? $100 invested, after 5 years you get 244, but in S&P 500 you only get 179, but it's a little bit shy from its own index. Okay, so that's the overall. So pretty much the stock does pretty well in terms of the 5-year progress. Okay, let's do the share repurchase. So one thing that surprised me so far, whatever I did a lot of stock research on my and posted on my YouTube channel as well, and I didn't find any other company at least who did so much stock repurchase. Honestly, look at here, the share purchase is own share repurchase on the November 4, 2019 to February 2020 until this year. They did, look at 11 billion, right, dollar value. That must be under the program, right? 10 billion during this period. Again, February 8 billion. So this is a lot of share purchase, and I see when this is also when they started, it says around 1.8 billion, and now it's only 1 point something billion share only outstanding. So they keep going time to time and buying the stock. And the second thing, actually, maybe I'll hide myself so you can see the full text now. Okay. So one thing I also liked very clearly, so board after this happened, the board in February 2019 also decided to have set aside 15 billion share repurchase program. So they also want to go ahead now and repurchase, go and purchase these shares. But keep in mind, there's the next line, the program doesn't have any prescribed expiry date. Maybe it might be affected by the coronavirus and so on, but it's still not very clear yet, right? Then when maybe it's not that immediate, but the board has make their decisions. Okay, so okay, so that's pretty good to have. Yeah, also on the dividend side, the dividend is also keep increasing, right? So maybe I can share very quickly. Okay, so here I'm on the Home Depot sites on the dividend history. So that's quietly nicely laid out there. So here you can see this is the in descending order. Let's go until 14 and 15. You see the dividend, which is the quarterly cash dividend, is coming. It's keep increasing, right, by 10 cents or more, right? So it's keep increasing. So it started on 29 or 22 and 10 cents, and now it's $1.50 per cents per share on each quarter, right? So okay. So let's go next. Okay, on the income statement, so this plot is basically give all the major the benchmark or the right on the income statement. So the revenue, operating income, income before tax, and the net income, and this is in the dollar terms. So you noticed this the income revenue, this increase quite consistently, right? If this is increasing quite consistently, the similar way all other net income and income before tax, it's also not bad. It's keep consistent increasing. But one thing which I doesn't like it, if you see this gap, right, the gap between the operating income and the revenue is a huge. So they have a lot of expenditure in between, right? So this what I don't like it. But overall, if you see from big picture, okay, looks great, not bad. So now coming from the operating and profit margin, so this is in the percentage, the same thing, and this is yearly basis, and this is until now. So the net operating margin, so this is around closer to 25 or 24%, within that range, and the profit margin is around, it was 7-8%, but then it grows up to over 10 and then come back around 10% or that, right? So that's their profit margin is going on. So and which is consistent and increased, so there is no problem there. The liquidity side, which is very important, especially in terms of the coronavirus, we need to ensure the liquidity of the company has enough so it can survive during this credit crunch time, right? So the liquidity is very good. So think that way, right? So the current asset is over this one benchmark, right? So it's way above 40 basis points above, so which is pretty good. On the pure liquid side, the cash, which is even way lower, I expect if the cash reserve to be closer or higher, but but that how it is, right? So from this side, so this is not that great. Okay, the overall this ratio is coming up, but more conservative side on the cash or the quick ratio, the very liquid like marketable security and all other stuff, which is not even covering 50%. So I'm pretty neutral on that, right? So on this one. Okay, let's go to the balance sheet. On the balance sheet side, I'm showing the very three broad category: total assets, total liabilities, and shareholder equities. So we know that total asset is equals to the total liabilities plus the shareholder equity. So this is the very broad term we are taking, and this is on the okay. So on here, one thing which is you can see the gray is the total assets, right? So this is the total assets on the gray side from 5-year term from okay 16, 17, 18, 19, 20. These are the years. These are the liabilities, right? So the liability you can see it's keep increasing, right? They keep increasing, and especially on up to 16 and 17 and 18 was okay, right? But you can see on 19 and 20, right, the liability surpasses the assets, right? So think from that perspective. If today company has to liquidate, something very bad happen, right? So they don't have enough to cover their liabilities, because so that's one of the reason their shareholder equity is negative, right? So nothing left for the shareholder, because the debt holder even doesn't have enough to cover to the debt holders, right? From that perspective, is not like the company is going bankrupt or anything today. We have to see from all other factor, but just we have to see from each side. So we have seen from the liquidity side, we have seen from the share purchase side, which is very good, dividend is good, but from all the angles, right? And I'm pretty transparent to point out all the facts, so we can make as an investor the good decisions for our long-term investment. So far I think if you like it, please do like the video, and if you don't understand this and other current ratio and all, I do have a video on my channel which explain those, which go in deeper into it. So let's go now in the next chart on the revenue growth, EPS, and the gross profit trend. Again, if you see from this perspective, the gross the earning per share, the gross, or sorry, the revenue growth. So revenue growth it was little over 5%, and then it's very this consistent with the gross profit margin as well, right? So you can see here, right? It's pretty much same gross profit margin and the revenue growth year by year, right? So it's pretty consistent. But on the EPS side, it's not very consistent. And the second thing is not very good in terms of the revenue growth, right? So I expect this is a very old company to have a very good, especially because I think that's one of the major stock there. We have Lowe's as well, but that's not very famous, at least in maybe people goes there, but that's Home Depot is first priority in terms of buying the thing, at least for us. But let's see what the number says here. So okay, so number is, yeah, so it's not that great, and it's even decrease even from the 5% mark, right, with the recent year, which I don't like it. So if the top line is not increasing, how we can expect the gross profit and other margin to do well? So the consistency is there, whether the revenue is up or down. I don't like this, honestly. Okay, now before we go into the models and come up with the intrinsic value, I just want to compare the fiscal 2020 and fiscal year 2019, which is the last year, the 3-month comparison, right? 3-month comparison. So I got it May 3, 2020, and this is the May 5, right? Okay, so if I see from the net sale perspective, that's very good. The net sale increase as compared to the last, right? So right, and the gross profit is pretty much consistent, that's we see, but the overall net sale increasing. If I come back to the net earnings side, you can pause this video and look more detail, but I just like to point out the key factors here. The net earning is decreasing to 7.9% as compared to the last 3-month ended quarter, right, which was 9.5. The main reason what I can see here is the selling and general expenditure, right, because they have less staff, and whoever is working, they need more, they need to pay more and all. So that's pretty much the cost, 2% you can see here, and then pretty much the same, a little lower, which caused the difference. Okay, So next, let's go to the model and see deeper what we come up into. So let me bring my spreadsheet. Okay, so here I am showing you the dividend discount model. So let me increase the font. So on the dividend discount model, I take the required return as 9.5% based on this the beta and all. So this is come from the capital model. So the 2019 the dividend per share is 5.43, and when I run the model, I got the short-term period growth rate of 18.85%. Actually, it was getting even higher, but then I got a little bit conservative and I use approximation with two models and use that. On the 5-year, then after 5 years, I assume that it go consistently. Here I am taking the 7.25, which is even lower than its historical rate. When I plug the number and then as you notice, the growth rate I am keep declining, just using the interpolations to come up to 7.25, and when I does that, my number coming as $335.70, which is quite higher than compared to the market price, right? This we can also see reflect because the company is keep going and buying back its shares, which boosts the shares and keep increasing. So an equity and keep increasing the dividend as well, right? So that is reflected here. But let's see, I try to use a couple of models and then come to the number, right? So when I use, okay, so on the free cash flow side, I have the free cash flow where I take this is a free cash flow for 19, and free cash flow basically is a little bit hard to grow. So the immediate short-term period growth rate is 9.36, which I then reduced to 5.64, right? And then when I did my present value based on this, I got $192.04. I think this is a little bit more better in terms of what I am getting. So then next is, if I take both the intrinsic value of the dividend discount model and the free cash flow model, this time rather than using the 50% weight, I'll give more weightage to the free cash flow models, right? I think this is more stable, and on the dividend side, it's bringing more. So that's what my take is, but if you want, you can do 50-50. All right. So I come up with $250, my fair value for it. Here I didn't add any discounted any margin of safety, but this is just average ballpark. You can think so. So when I go to the market right now, the price is a little bit higher than what my expectations actually is. $10 some higher from that, right? Okay, so let's go back to the slide and try to form opinion now. So we have covered pretty much many things. So now we are closing the video. Now we need to form the opinion, right? So overall, if we see from the model perspective, the price is a little bit overvalued, which I haven't shared. But I can also see from the EBIT enterprise value over EBITDA ratio as well, which was coming average a little bit over than the historical average as well. But given that concern, the company is been very stable, and I think the company has a long-term future, right? But so we can see that some good point is, okay, it has some good share repurchase, dividends is increasing, but one thing, but does it makes a good from the long-term perspective from the portfolio? From the financial perspective and overall perspective, I didn't see any problem with the company. But at least from my portfolio perspective, one thing I don't like it. I don't want, if I go to the very first slide, right, it has 2,000 some 100 stores, right, which is a very heavy in terms of the brick and mortar. And then also they need to have very qualified person inside the stores to make those sales. So to keep them, and I usually find there are very less number of present in the store, at least in our area, and it's very hard to get their time. So from that perspective, people are going here and there, right? So I think the company is not doing enough to have more number of people so they can have more sales. That's my informal feedback. But on the main thing on the store wide, I think this is a very old model to have a very big, like a warehouse kind of a store. You have few people there, and then it keep running. They should have some online presence so they can print more of the money. That's my first point. This maybe some people will say no, that should be okay, but I don't think so. They need to be that in a premium location to do that. The second thing which I don't like it about the company is they haven't, they've been so capable, but why they are not going into the emerging market and other countries where we have very spike in terms of the infrastructure and all, right? I do like to see that kind of a jump rather than being in the mature market, like is a very good market, but US market which already is developed, but especially like let's say India or some other neighbor countries of India, they are doing a lot of infrastructure right now at the minute. I do like to see the company present, and I'm very surprised the company doesn't show the name there in the Asian market and or maybe in Africa, right, where is the next big. So that's free. So for the price, the same. So that's the reason for the same price, which is coming in $250, I can buy something else which drives the higher growth, right? So that's okay if the company is going and buying back the shares. I'm not very keen. I'm keen on to increase the top number, the revenue, which is very low, increase year over year, and the bottom line increase, and make some strategic good decisions rather than just thinking and going at the slow pace. So that's one of the these are the reasons. So I'm not investing in this stocks. That's my personal, but overall from the financial and other perspective, because different portfolio has different, the stock has no problem, okay, from the investing on the investing side. So that's what my view. If you like this video, please do give a thumbs up as shown here, and do comment on the channel if you, and share as with the many people, so more and more investor can join this. Okay, so thank you, and hopefully see you soon in the new video. Thanks, and bye for now.